Welcome back. We've done one video already on AT&T, but it was one of my earlier videos, and we've also had some news come out. We had another quarterly report come out and the news about the dividend. So I want to go through it again, but we're going to do it a little bit differently because this thing is actually really undervalued at first glance. And look at the 10-year price chart, okay? It's at a 10-year low or close to it. The 10-year low was like in November, and we're not far off from that. So what's been going on over the last 10 years, and is this drop justified, or could it just be gearing up and ready to pop off again? We'll see. That's what we're going to look at. Real quick though, look at these ratios. I mean, the PE is 8.7, price to book's 1, and price to sales is 1. I mean, it's kind of crazy. You don't really see stuff like that and also be at a 10-year low. So we're going to look at it, and I want to start a little bit differently. I'm going to start with the valuation and then work backwards. So, spoiler alert, here's my valuation. I get a price target average of $35 a share. Our estimated pre-tax income times 10 divided by the number of shares gives me an average of 32. Earnings per share growth formula from the Intelligent Investor gives me a price target of 35. And our DCF gives us a price target of 37. That's with free cash flow, $26 billion, a perpetual growth rate of 2%, and discount at 13%. I used to discount at 15%. For the purpose of the videos, I'm going to start discounting at 13% because I think that's a little bit more realistic, but I'm also going to have a little bit of an increased margin of safety on my own purchases, okay? All right, so look at these valuations. I mean, $35 a share, that's potential 45, 46% upside from the current price. I mean, that's outstanding. That's the kind of stuff we're looking for, right? And just in case you think I'm crazy about this valuation, watch this. I'm just going to pull it up on Google. All right, let's see. AT&T fair value. $36.49. Okay? Pretty close to what I got. I mean, I don't know what website this is. I clicked on it, but I couldn't really understand it. But anyway, it's, like I said, it's obviously selling at a discount. All right, so now what we're going to do is we're going to look through the financials and see if we see any red flags that could maybe show us why this is selling a discount, why it's at a 10-year low. So let's get started. We're going to work backwards. We're going to start with the cash flow statement. Let's go. First up in the cash flow statement is our free cash flow. And this is our cash from operations, so cash that the business brought in. And then we subtract out capital expenditures, which is big investments into either buying new assets or big maintenance on their existing assets. All right, so look at this free cash flow. This is an amazing trend. This is crazy. The free cash flow is growing like this. This is every quarterly report going back to March 2003, so like 19 years. So look at this free cash flow growth, and then I'm going to pull up the stock price again. Yeah. So the 10-year stock price is like just down, 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 but yet the free cash flow is rising. That's kind of crazy. I'm not used to seeing that. Okay. So far, so good. Next, we're going to look at depreciation. So depreciation is really something that affects the income statement. But what it is it's a way to represent how much their assets are losing value, how much they're writing off for tax purposes on their assets every quarter as depreciation. So they're depreciating $6 billion close to a quarter in assets. That's a ton. So remember, their free cash flow, let me go back in this. So their free cash flow was $6 to $7 billion a quarter. That's insane whenever you compare that to depreciation of like $6 billion a quarter. Wow. Okay, so that's depreciation, but we always like to compare it to capital expenditures because that can tell you a lot about a company. So depreciation is on paper how much money the assets are losing value per quarter, and then capital expenditure is a better representation of, in actuality, how much cash is having to be put back into the business. Okay, so here you can see it's only $4 billion a quarter. So we're depreciating 50% more than we're CapExing. That is very good for cash flow. If you want to maximize cash flow, you minimize capital expenditures, right? The issue is that it's not very sustainable for a lot of companies. I know I've talked about this before, but Warren Buffett has said multiple times, it's very hard to run a business that spends less on CapEx than depreciation. Now, that being said, I mean, they're doing it, and they've been doing it for some time, and it's generating a lot of cash. So the question you got to ask yourself is this sustainable, or is the free cash flow going to start to regress and go back towards the pre-tax income because eventually you're going to have to start spending more on CapEx? I think in their case, if you think about what AT&T does, they have a lot of infrastructure, and they probably depreciate that stuff over, 10 to 30 years. But a lot of that stuff is actually going to last longer than 30 years. So we might be having a case where things are outlasting their depreciation, which is why you're having to spend less on CapEx. So it could be a good thing. That's all I'm saying. It's just interesting. All right, so now we're going to look at dividends because, AT&T is known as a big dividend payer, and there's news recently about their dividends. So let's go to that. All right, cash dividends paid. They've been paying $3.7 billion a quarter in dividends. All right, that is crazy whenever you compare it to their free cash flow of 6 to 7. So their free cash flow is between 6 and 7, so let's say 6.5. So 3.7 divided by 6.5. 57% of their free cash flow is going to dividends. All right, here's my view on dividends. I think that they're kind of like a last resort thing for a company to do. I think first they look to make sure they're in a healthy financial position and don't have a ton of debt that they need to pay down. I think second, they look to reinvesting in their own business and see, if they can get a better return than what you might be able to get if they just paid that money out to you. And then lastly, before dividends, they need to look at their own stock price and see if it's better to return value to shareholders by buying back shares. Now, real quick about dividends, I'm going to talk about buybacks in a second. So the news is that their dividend is getting reduced to $1.11 per share per year. So just up here on the calculator, $1.11 times the number of shares, so 7.1 billion. They're going to be spending $7.88 billion a year in dividends. So I divide that by 4 to get a quarterly number. And you see we're going to be closer to $2 billion a quarter in dividends. So their dividend's going to go to about right here, $2 billion a quarter. All right, I actually think that's probably good for the company. I think that the dividend was putting a huge load on this business that it really couldn't support, and I'm actually happy to see them reducing it. And you'll see why later on as we go through. But let's go to share buybacks real fast. Let's see. Share buybacks. Repurchase of capital stock. All right, let me erase this. All right, so they're not buying back shares. They did a couple times, but wow, they spent big dollars buying back shares every once in a while. But let me talk about buybacks for a second, because I really think this is a much better way to return value to shareholders if you think the stock price is undervalued or even at fair value when compared to dividends. So to show that example, I want you to imagine you're in a business partnership with 2 other guys, so 3 partners, and y'all each own a third of a business that is worth, let's say, $1 million, and it's making $100,000 a year. So it's selling, 10 times earnings. All right, business partner C wants the earnings paid out to him, at least 50% of the earnings. He says, look, man, I need cash. I want $50,000 a year from this business. We can keep the other $50,000 in the business to grow it. You and partner B, so partner A and partner B, say, no, we want all the money to stay in the business because we think that the business can get better returns than we could get if it paid it out to us. All right, so how do you resolve that issue? You have 3 partners, 2 of them want something different than the third one, all right? I mean, you could just vote and say, screw you, shareholder C, but who wants to do that, right? If you paid out a dividend of $50,000, then you and shareholder B both get money that you didn't really want, and you got to pay taxes on the whole $50,000 of it. It's crazy, okay? The best option is actually for you and the other shareholder who wants to keep the money in the business to use the cash from the business and buy out $50,000 worth of person C's shares. Okay, so basically, if you do that, you and person B have an increased stake in the company, and the money has stayed in the business, and shareholder C has gotten his cash that he wanted. And on top of that, it's better for taxes for that guy too, because if he sells $50,000 of the stock, he only pays taxes on the gains on the stock, not on the whole $50,000. Whereas if he gets a dividend, now he pays taxes on all $50,000. So it's a win-win, assuming the share price is at fair value. The shareholders that want to keep their money in the business get to keep it in the business. The shareholder that wants to get some cash can exit his position a little bit, all right? And that's assuming the share price is at a fair value. If your share price is at a discount, the math becomes even more favorable, okay? So this is what's kind of frustrating me here, is that I think that their distribution of wealth to shareholders is pretty inefficient, because if the stock really is undervalued for AT&T, I'm going back to AT&T now, and do I need to pull up that 10-year chart again? I mean, it's low, low, low. I think that they can return a lot more value to shareholders by buying back shares than just paying to dividends. Now, that being said, remember I said that buyback shares, I think, comes after looking at reducing debt and reinvesting in the business, and you're going to see that there's one of those that I think they should do even more than buying back shares. But still, I think dividends is the last resort, and it kind of frustrates me that they jumped right to that. I mean, them reducing the dividends is nice and all, but yeah, that's just my 2 cents on it, okay? Let's go to the balance sheet. All right, first up, total liabilities. All right, so total liabilities, they have over $350 billion of total liabilities. Billion with the B, okay? That's crazy. Think about this. Our ratio that we like to do is free cash flow to total liabilities, it's liabilities to free cash flow. So this tells you how many years would it take for a company to pay off all of its liabilities. So you do 350. I mean, I know it's a little bit above that, but I'm just going to do 350 billion. And I said they're making 6.5 billion a quarter. So 6.5 times 4 gives me a yearly number. So it would take them over 13 years to pay off all their liabilities with their free cash flow that they're generating. That's terrible. There's no other way to put that. There's no sugarcoating there. That's terrible. Whenever I talked about the first thing a company should look at whenever they have cash is, can they reduce their risk? Can they put themselves in a healthier financial position? To me, I mean, they should be looking at this debt load a lot, because this is crazy. All right, and I want to show you something else. So if you look at the debt to equity ratio, which a lot of people do, so here it is, debt to equity. All right, people say, okay, debt to equity ratio 2, that's good. So they're actually in a healthy financial position. All right, so this is why each video is different, and you can't just follow a pure formula when valuating companies, because you could look at this debt to equity ratio and say, 2 is good. And or you could look at it and say, okay, 2, and you go to Google. So let me pull up Google again. And you say, what is a good debt to equity ratio? All right, and it says 2 to 2.5 is generally considered good. So you say, all right, we got a good debt to equity ratio, right on. All right, here's the issue. AT&T has a ton of intangible assets. All right, so let me show you this. So if I go to their total assets, you can see they have $550 billion of assets. That's crazy. The market cap's 172 and they have $550 billion of assets. All right, now look at this. Their total tangible assets, though, is only $250 billion. So they have over half of their assets in goodwill or intangible assets. So over half of their assets are things that aren't real. I mean, that's super spooky. And if you look here at their tangible book value, which is their tangible equity, you can see, where's tangible equity? Tangible book value is negative, okay? So, don't be fooled by the debt to equity ratio of 2, or don't be fooled by the price to book ratio of 1 that we saw. If you remember in the first part of the video, the price to book was 1. Well, actually it's negative. So you got a negative net worth from a tangible basis. So not too good, and decreasing. All right, so here's the other thing. I know that we like to judge the pattern here on the tangible book value because it's like a net worth of the company. But when a company is paying so much in dividends, this is really kind of a bad judge, because if a company's paying a lot of its money in dividends, that's money, like I said earlier, it's just leaving the business. So it's not building the net worth of the company. That's not a bad thing. But at the same time, you really don't want the net worth shrinking. To me, that just means that they had a sloppy dividend policy, and that just reinforces my other beliefs, I think. Oh man, I'm happy that they're reducing the dividend, but I'd like to see it go to 0, to be honest, okay? Bring that thing down. Use the money better. All right, let's go to the income statement real fast. And we're just gonna look at a couple things here. This is the total revenue, it's kind of flat, but I wanna just do pre-tax income. All right, so look at this. This is just sad. So pre-tax income is pretty flat over the last, 15 years? And let me show you the assets again, because this is pretty frustrating. So your asset base, the number of assets that you own, have just gone up, all right? Increased in the last 15 years from $270 billion to $550 billion of assets, okay? Why do you buy assets? You buy assets because you want them to make you more money. That's why we always look at return on assets. Okay, but what's actually going on? You're just flatlined right at $5 billion a quarter. And you have these random negatives that it's just, I talked about those in my other video. That's write-offs, but still, this is just not good at all. I know recently they're up in this $6-7 billion range, which is why the valuation is so favorable if you go back to my valuation page. But really, this is just not good at all. It's usually a sign that management did not do a good job buying assets. They did not do a good job investing capital, and they're just getting pretty bad return on assets. If income's like this and assets are going up, what do you think is going on with return on assets? All right, it means it's going down. So really don't like seeing that. It's kind of disappointing. All right, so let's go to interest real fast, just because there's one other thing I want to show you about this. We already talked about their debt a little bit. But look, they're spending over $1.5 billion a quarter in interest. Now, it's come down recently, which is good. That means that they are paying off some debt, or that they restructured their interest. So this goes back to the, free cash flow, and should they use their cash to do dividends or buybacks. Look how much money they could save if they just reduced their interest. So remember, their pre-tax income was kind of flat at $5 billion. And right now they're spending, 1.7 on interest. So if I'm up here in the calculator and I do 1.7 divided by 5, it's like 34%. I don't know what their operating income is, but I'm sure it's a high percentage of that too. So it's just not good. But anyway, let's go back to valuation. All right, so these numbers, and this is a great lesson in valuation, because these numbers are really just based on earnings, but there's not really any metrics here describing the qualitative side. That has to come from your own research and stuff, and that's kind of what we did in the rest of the video. I think if you watch the video, you know that this is going to be a stock I'm staying away from, even though the price target is 45% higher than what it's selling for right now. I just think there's too many red flags with the company, and it's just been sloppy management for the last 10 to 15 years. I just don't want to be along for that ride. I feel like it'd be very frustrating. So look, things can change. They're making so much money. It just seems like they're not spending it right and or investing it right. So I'll definitely be keeping an eye on it, because look, what's stupid at one price is smart at another, right? If this share price dropped, in the teens or something, obviously I think it would be a good buy then, but at the same time, like I talked about before, I've kind of shifted my focus to buying companies that have great qualitative and quantitative measures instead of just the quantitative side. And a good example of that is actually Intel, which is video right there if you want to watch that. But check out more on my channel if you like this video. If you learned something, like and subscribe. I'll see you next time.